Good day, ladies and gentlemen. My name is Mark Larishin. I'm a financial advisor, and today I'll try to make a little introduction to you into investing, more specifically into investing into American stock market, which is actually available to absolutely everyone around the world. So it doesn't matter which country you're from, well, most of the time, but usually it's okay. Let's start today with just a general question. What is a stock? By the way, even though this course is directed towards a beginner, I suggest you to use time codes below in case you know something, which I'm going to tell you right now. You can jump into the section which is more interesting to you. You have two types of companies, private and public. For example, Lego. Lego is a good example of a private company. It belongs to a family, if I'm not mistaken, and we don't know much about them. We don't know their financials, nothing, because it's a private company. But we also have public companies, such as, well, let's go and check out NVIDIA. Well, NVIDIA, it's because right now it's the biggest company in the world. That's why I'm talking to you about NVIDIA. My point is, it is a public company, so we know a lot of details about it. In fact, if a company is public, it means they are listed somewhere. For example, in this case, NASDAQ. Okay? They are required, it's a prerequisite to publish their financials every quarter, every half a year, every year. There's a clear financial information on those companies. So we know much more about public companies than about private companies. You can invest in private, but not through a broker. Typically, it's a different story. So today we focus only on public companies, such as this. Okay, that's one of the absolute best performing stocks lately. You can see 1.2,000% over 5 years. You can do your own calculations. If you put 10,000, 100,000, $1 million into that, you would have become very, very rich if you invested in this one. Well, with stocks, it's not so simple. Sometimes it can get complicated. Well, for example, you think, okay, we have AI boom right now, right? ChatGPT is growing and everything, and NVIDIA is the hardware behind AI for the most part. Well, what's the competition to NVIDIA? Perhaps you should invest in that too. Well, let's check out AMD. And if you've ever been a gamer, you probably heard this name before, right? AMD. Over the last 5 years, there is a very solid growth, about 150%. But it's not 1.2,000% like NVIDIA has. You may also think, who else is making processors? Well, maybe Intel, right? One of the OGs in the industry. Well, let's check them out. Intel, over 5 years, actually kind of lost almost 30%. What was going on? Well, the point is you need to know the financials. And Intel has been behind for a long time. Apple with their M1 processors, they've been doing a really great job lately as well. So Intel has lost a lot of market share. It's on the point. Point is, it's much easier for beginners and even intermediate investors to invest not in the stock specifically, but into the collection, a basket of stocks. And here we come to ETFs, exchange traded funds. Okay, once again, exchange traded funds. That's a collection of stocks. It could be 10, 100, could be 1,000 different stocks all together. One of the absolute most common stocks is S&P 500 ETF. Well, what do we need to know here? S&P 500 is an index, such as this. It's more like a list of 500, well, it's 503 actually. Currently, it could be changing. Every year it's actually updated and it's different. At this point, it's 503 companies, but as you can see, it's been founded 68 years ago. Crazy, right? Point is, these companies change all the time, and you never know who's going to be on top next year. If you don't want to think about it, you can simply buy an ETF. For example, one of my favorites, VOO. That is the ticker. That's the ticker which you will put into your search box on your broker and actually buy. But there is many different S&P 500 ETFs. For example, let me Google it for you. Let's say SPY is probably the most common among them. So I showed you VOO, SPY, and let's actually compare. Over the last 5 years, we have a growth of 93.3% for SPY. For VOO, it is exactly the same. And even if you look at just the index, which is not attached to ETF, it's right about the same, because the whole point of an ETF is to mirror that list. What is the difference between VOO and SPY? SPY is older. As you can see, if I put max length here, we go back to 1993. And for VOO is going to be something like 2010. Yeah, as you can see, VOO is younger, which for us usually means liquidity. SPY is much more liquid, meaning more people trade it. So if you want to buy it, more people are willing to sell it to you. If you are selling, more people are willing to buy it off your hands, because that's investing. Someone has to buy whatever you're selling, just like in real life. So that's what it is. Some of them also can be not equally or equally weighted. For example, SPY and the VOO, they are the most common ones, they're not equally weighted. Meaning companies like Microsoft, Apple, Meta, they take up more percentage of that wealth, of that fund, than other companies. For example, if you check out something like Vici or maybe O is also a part of S&P 500. It's a company which buys real estate and then leases it to something like places like Walmart or Starbucks and such. You understand, big businesses, and they have 10, 20, 30-year-old leases, which actually are very good for their financials. Point is on that, but you get, in my understanding, more equally weighted indexes or indices of S&P 500 perform a bit less because some companies were just not designed for growth. For example, Realty Income Corporation, O, is more of a dividend-paying company than growth company. As you can see, over 5 years, didn't change much at all, minus 1%, almost nothing. But they are paying the dividend. Dividend yield is what you get pretty much every quarter, normally every 3 months, into your account. It's just cash. So you do have the capital appreciation and you have cash. You can compare this best to owning an apartment. If you buy an apartment and rent it out to someone, you get the rental income and the capital appreciation of your apartment. But usually it is appreciating, right? So that is similar. Well, so now you understand about the stocks. Okay, let's move on. Let's go to this page. Here, we have a few basic information blocks which you need to understand. And it's very simple. So first, management style, it's an index. This one is passively controlled index. There's two types, passive and active. Well, that's a good example of passive, meaning it's just an algorithm which updates the companies and manages the fund. And this is why it's much cheaper. Expense ratio 0.03%. This is what you're paying every single year to the company, in this case Vanguard, for servicing this particular ETF. This is a very low number. Of course, well, you're gonna make much more money even if you just look at the yield. Remember, dividend yield. So per year, that's the percentage. It's much more than the expense ratio. So of course, you're gonna be in a positive with just the yield. But don't forget, there's also capital appreciation for the stock. So that's why this is almost negligible. But SPY is actually more expensive, just a bit more expensive than VOO. And this ratio can be changed. These companies can adjust it, how much to charge for it. So that's a floating number. In fact, if you go to the page of another very famous index, VGT in this case, ETF, you'll see that they actually lowered the expense ratio, I think including this one, yes, 0.09%. It was higher before. So it's a floating number, as you can see. But let's go back here. Now, index, we understand, right? The expense ratio, you understand, that the yield is lower for VGT because it's a tech-driven ETF, mostly for technology, and it's growing much faster, much harder, but it pays less. I hope you understand. Some companies are growing faster, like Tesla. Tesla pays 0 dividend, but they are driven for growth. And some companies like Coca-Cola, Chevron, McDonald's, Walmart, they are paying more dividend and less growth because they're not growing crazy. It's a big established business, okay? And I will tell you in the end of this video who it's designed for. So basically, at a certain age, there's a better collection of companies you should invest to. Because if you're younger, probably you want more growth than income. And when you're older, you want more money coming to your account in a more predictable way, so to speak, right? Okay, well, let's move on from here. What else we have? That's a market price, 757 in this case. That's how much you need to pay for this index, for the ETF. Point is, in most brokers, if you want to buy VGT, you need to pay whatever it costs on that day. Right now, 757 is pretty high price, actually. There has been a bull run in general. Bull run is when the stocks are going, well, really high. As you can see, look, that's not exactly a bull run, but I mean, it kind of is. Look, 33% over the last 6 months. If it's not a bull run, I don't know what it is. And sometimes we have a bear market when stocks are kind of going from left to right. In fact, I'll show you a good example of that. Like this. That's a bear market for O. But remember, right, they're still paying you money. Even if you didn't make anything on the capital itself, you still made money in dividends. 5.4%. It's not so bad. What is it? 5 times 5, 25, but it has to be a compound interest, don't forget. So we are more like closer to 30-ish% of real money made here. All right, we have thousands of different stocks, but what I'm showing you right now, most of the companies which are a part of S&P 500. And let's go back to the page of S&P 500. So that's how much money to pay for the stock. In some brokers, that's you have to have a broker. You can't, even if you go here, it's still a broker. Broker is a company which manages your stocks. When you buy stocks, you can even transfer them between different brokers, but it has to be a broker normally. Okay, and it's actually much more convenient to have a broker than not. There are limited instances when you don't have it, but for our case right now, for non-professionals, I mean, for beginner to intermediate level investors, we should not even waste our time thinking about it. So some of them actually allow you to buy fractional shares. That's not typical for brokers, but some of them do allow you. For example, you can buy $50 of it, or 150, or 300, doesn't matter. It will just kind of spread the share into smaller parts, and you own a smaller share of it, if you know what I mean, right? Point is, one of those is, let me Google to you, is Interactive Brokers. I do have a link for you below under this video for registration for this one. There's a bit of a commission, which I can get. So actually, commission, it's a free gift to you and to me. It's exactly the same for both of us. So, I mean, for you, costs nothing. So why just not do it through my link, if you don't mind? It's absolute standard practice. So, I mean, it's up to you, of course. But if you register by yourself, you'll probably get just nothing. You can help me out if you like this video. So that's one of the good and actually one of the biggest brokers in the world. Some of these brokers, if you search around, some are registered in Cayman Islands or Cyprus, some other interesting weird location. This one is only registered in the United States, Great Britain, and Australia. Okay, so that's normal, controlled jurisdictions. Okay, so enough advertising. It's actually not advertising. There's many other brokers, but it's just the one which I'm using, which I like, and I understand. It's actually also very, very technical. It's like a fighter jet of brokers. They have absolute everything you can imagine. And what I'm telling you right now is pretty much 0.1% of what is available on the platform, okay? So let's go back to our structure. So I think I told you actually most of the information about this block, so you understand most of it, okay? Well, the risk scale, look, 4 out of 5 for VOO. I would not agree with this number. Perhaps I would give it 2.5 out of 5 maybe. Well, because it's not exactly risk. It's like a base ETF which you need to invest in, okay? And by base, I mean, look, imagine, let me give you a very simple explanation how you should invest for dummies, so to speak. So a third of our portfolio is a good idea to have in something foundational, like this one. VOO is very foundational, has 500 companies, very diversified. It's good. So a third, VOO. Another third is something more growth oriented, like VGT, Information Technology ETF. So we have more companies which are a bit more volatile, but they can also grow faster. Let me show you what I mean by that. So this is VGT. In 5 years, it grew 135%. If you compare this to a more foundational ETF like VOO, you'll see that in 5 years it did 93%. So it's still growth, but lower. 93 versus 130% for VGT. And another third, my recommendation is to put something even like properly foundational, something like SCHD. And if you watched any other videos about investing, you probably heard this name many times before. I don't think that's the holy grail of the dividend ETFs. As you can see, that's a Schwab US dividend equity ETF. By the way, see, that's the total expense ratio. Pretty much that's the same block of information you'll find on all of the ETFs. So there's many others, but that's a good one because it has very stable companies like Chevron, like McDonald's, like Coca-Cola, Pepsi. So that's the company which is very solid. Look, it's also growing, but this percentage-wise, there's less growth over 5 years. And about the dividend, they don't show it here, but dividend is available on the official website. For some reason, just Google didn't pull it up. So it's about, what is it? I don't want to waste time looking for it right now, but it's about 4 and 5% per year. It's in this range. Okay, let's go back to our structure. So we learned about stocks, right? Those are publicly traded companies stock which is fully available on a platform, and it's clear and transparent. You can read the documentation of that company which you're investing in. It has to be public. That's the prerequisite. Private companies don't have to do that. You can still invest in private companies. In fact, you can just do it with your friends in a garage. But again, it's a very different game. ETFs are baskets of those stocks, which are a bit safer to invest in because if you invest in industry, you know AI industry is growing, but you don't know which company is doing good and which company is going to fail. And a bunch of them are going to fail. It's just a fact. Okay. So it is what it is. Now, why do we need ETFs? They're very simple. Of course, you can buy all the stocks yourself. You can open all 500 stocks which are part of, let's say, VOO, right, like this one. And actually, you can find right here in the portfolio all of the stocks. And usually you can just go and buy them. But why would you do it? It's just such a waste of time. It's much more efficient just to pay a little fee to the company and to let it handle for you. I'll remind you, these ETFs are rebalanced every year, sometimes even more often than that. Like SDHD was rebalanced recently, everyone's freaking out. Point is, there's different companies. It doesn't have to rebalance. It can stay the same for 35 years. But sometimes it does because it's following a specific index. If the index is changing, the ETF is also changing. Okay. If you have any questions so far, let me know in the comments. I'll clear things out for you. If you want to talk to me directly about investing, if you want to set up an account, also you can find the link below under this video. Also, I made a stream on that same topic earlier today. Every week, usually on Sundays, I make a stream. If you want to be part of that, you can. So for now, let's move on. Okay, so why there are so many different ETFs? As I told you, some of them are oriented for growth, like VOO, VGT. This one is even more oriented for growth, right? Because it's tech companies. Some are more for dividends, SDHD and JEPQ. Let me show you actually. JP Morgan Nasdaq Equity Premium Income ETF. Oh, that's a very, very good one. That's a covered call. And if you remember, in the beginning, I told you there's two types of ETFs, actively managed and passively managed. Most of the times, when we talk about ETFs, it's passively, algorithmically managed. But this one is actively managed. And check it out. There is actually a team of people who are managing this specific portfolio. Okay? It's a covered call ETF. I'm not going to get into depths right now, but look, that's the yield they currently have, 11% approximately. It's a lot. So let me pull it up in Google so it's more clear to you. JEPQ in the same interface. Imagine you just sold an apartment. Let's say it's $100,000. And that's pretty much an equivalent of renting out an apartment as an investment. Look, you can buy an apartment, let's say, and then over 5 years, you have a little modest growth percentage-wise of your capital, which is similar to most apartments in Europe. It's actually much more than typical number in European countries. But you also have a dividend. Now, again, it's not shown here, but it's real and it's shown here. You can also check Apple Stocks app. It's very good. It pulls up all the normal, correct information, unlike Google for some reason. Again, Apple Stocks is available right there on your phone. You can double check all this information all by yourself. So as you can see, right now it's about 10, 11%. It's fluctuating every month, but that's a good thing. You get payouts every single month between the 1st and 5th of every single month. So that's a very solid fund for income. Well, it's usually recommended for people who are a bit older. For example, I'm in Thailand here, and a lot of people come here and live on passive income. But if you're younger and you try to grow the body of the capital as much as you can, probably not the best idea to keep all your money here. I still do, but not all, but a part of it, of course. It's more typical that people will be investing in something more growth-driven, so to speak, right? And stocks in general it's a base. It's not something which only rich people should do. It's actually, everyone has to be doing it. Look, let me show you, for example, Norway Wealth Fund. Look, Norway is a good example because they sell a lot of oil, okay? And they accumulate the profits and then they spread these profits among its population. How? They put in a fund and per person it's about like $1 million plus, or if not 3 million right now, actually. Let me pull up some pictures. Look, so their fund is growing. This are the money which are going towards pensions, towards social welfare, and so on. And it's growing year by year, as you can see. It's very, very good. And that's per citizen. What is it? 3.2 million. I think it's a Norwegian krona. So probably like, I don't know, is it $1 million? Well, it doesn't matter. Number is very high and highest in the world. It's absolutely known fact. Well, how they do it? Okay, so they sell oil, they take profits, put in the fund, and then they invest all this money. Yes, government is managing this portfolio of citizens' money. and they invest globally all around the world, and including in those exact ETFs I was showing you, and other American and non-American stocks. It doesn't matter you have $5 million or $50,000. You can't just let your money be cash, because cash is a more transactionary period for money. Let's say you have an apartment, you sell, you have cash, and you invest in something else. But you don't keep your cash under a pillow because it is depreciating. It's a fact. Look around, prices are growing. So not euros, not dollars are not immune to inflation. That's why money has to be working. Small or big, doesn't matter, have to be somewhere. So also I can give you another benefit. Well, when the person dies, well, let's say we're talking about the United States right now, then let's say your son gets your portfolio, then he doesn't need to pay any taxes. And if he was getting your money in cash, you have to pay like 50% on your cash, or an apartment, or land. You understand what I'm saying, right? It's the most tax efficient way to preserve generational wealth. And of course, a lot of people don't know about it. A lot of poor people that they don't have much invested, and they'll be giving out their houses to their children, and then children need to pay a whole bunch of taxes on the houses, and most of them just sell them just so they can pay the taxes. That's absolutely horrendous. My point is, investing is something, it's basic. It has to be taught at schools. You have to have the basic knowledge how to do it, and you have to do it yourself to a certain extent. If you want to talk to me more about it, if you want to be educated, if you want to make your account, again, links are below. But let's go back to our structure here. I think we learned most of the things we needed to learn. Now, slide number 4 here is VO versus PY, okay? I think I already told you the basic information about here, and you tell me right now what is the difference. Pause right now for a sec, click pause, and think, what's the difference? Okay, I'll tell you now. So this one has higher costs, slightly higher cost per year, and higher liquidity, meaning way more volume traded of this exact ETF. More people buying, more people selling. VO is a bit smaller, but look, it's smaller, but it's more like comparing Pagani versus Lamborghini. Both are supercars. Yes, one is more expensive, but it's still there. It does, for us, in particular case, it doesn't matter. Vanguard is like second biggest after BlackRock. Look, so you don't have to be concerned with liquidity for neither of them. There's many other stocks. As I told you, for example, if you check Vici, they own properties in Las Vegas, and then they rent out the properties to MGM Grand, Bellagio, and other casinos. And as you can see, that's their stock in 1 year, didn't grow much, but they do have a dividend again. See, this is not a growth company, that's a more of an income-driven company, and that's their payout. And if you want to buy them or sell them, you can notice in the app when you do it, there is a minute between your order being filled. And if you try to do the same with Apple or Nvidia, it'll be instant, very quick. Well, it also depends on the price you put, because you can set your own price when you want to buy or sell, okay? So let's move on from here. Okay, well, passive and active ETFs, we also talked about it earlier. Remember, what's the difference? Which one is passive, which one is active? Remember, JEPQ is a good example of an actively managed ETF, because there's an actual team of people managing it. Is it makes it a bit more dangerous? Well, it's another topic for another conversation. In general, no, because even though there are people, they still use math and algorithms to operate. It's not like they're just sitting and relying on their emotions, how to operate. They're like pilots. They have instructions and a to-do list how they do it, okay? So it's a different conversation. Growth or dividends, well, look, even if you are 30 years old and maybe you just want to stop working, have a whole bunch of money, and you have $1 million, well, put it into JPQ, you'll have like $100,000 a year of income, or more or less sometimes. I mean, well, you can live on that, no problem at all. Okay, if you have 100,000, you'll get about 10,000 of passive income. You don't need to do much about it. So, and the body of the capital is growing. It's very good, very cool. But again, generally when you're younger, when you want to build up your momentum and grow your body of the capital. Okay, so most of the time, this is the final takeaway for this video. 2 or 3 ETFs are more than enough for most portfolios. In fact, that's what I recommend to my clients usually. You don't want to overcomplicate, because ETFs are already diversified. You have 500 companies in VO, you have like 100 companies in SHD and whatnot. So it's a lot of companies already. Yes, the weight of them can be a bit different, but again, come on. You can, some people prefer just to put all their money into Coca-Cola or Microsoft or something else. That's a little bit riskier, because even though obviously it's a huge company, Microsoft has been performing very, very well recently. I mean, it's not the most prudent decision, okay? And that's pretty much it. Well, okay. All right, so the link is below for Interactive Brokers if you want to make an account. If you need help creating this account, it can be a bit tricky with the taxes, with setting up questions, like margin, cash account, whatever. As I told you, it's a fighter jet of a broker. It's not as simple as just like your consumer level acorns or something. Okay. But again, it's very powerful. If your goal is to invest into the next 10, 20, 30 years, that's the goal. And it's available worldwide. Meaning if you are from African country, Europe, Eastern Europe, South America, doesn't matter. You can make an account and use it. And it's also the benefit of it is that you put your money outside of your country's jurisdiction. I'm not going to advertise you the reasons why people sometimes want that, but that's a good perk. And it's also good for your own personal diversification. As I told you, IBKR is registered in UK, Australia, and USA. Is pretty cool actually. Those are very solid, strong, heavily controlled jurisdictions. This is not some Cayman Islands. Okay, so we don't need to overcomplicate, of course. Discipline over complication. Look, what we mean by discipline. Well, let's go check VOO stock. And look, exactly half a year ago, why we have such a growth, happened Liberation Day. Donald Trump imposed tariffs on other countries. Basically, I don't want to overcomplicate for you. Basically, the market was very uncertain, so there was like a 20-30% drop. And it's very hard to buy when it's going down. You have to buy when it's red, when it's going down. That's the whole point. But it's very hard to do. That's what I did. I got lucky selling my apartment right about that time. So I put a good chunk of money into that in direction. By the way, if you look at the years, I'm in Thailand right now. So this is Thai years. And if you didn't know, in Thailand today is 568. Don't break your brain right now. Point is, investing is easy. Buy when it's red, sell when it's green. In practice, that's the hardest thing in the world, okay? It is what it is. Guys, that's pretty much it for today. If you want to talk to me, there's a link under the video with more information. Thank you so much for watching. I'd love your comments. If I missed something, maybe you don't agree with me on certain points, then let me know in the comments. I'll definitely reply to you. Guys, thank you so much for watching. You go have a gorgeous, beautiful day. See you later. Bye-bye.